Welcome, everyone, to the Information's TITV. My name is Akash Pasricha. It is Tuesday, November 4th. We have got a jam-packed show for you today. First up, we've got our earnings blitz. Uber and Shopify reported this morning. Palantir reported last night. We've got our reporters coming on to help us break them all down. We've also just published some big news that Anthropic is dramatically raising its growth forecasts. We'll tell you more about that shortly. And after that, we're bringing on our editor-in-chief, Jessica Lessin, for some broader reflections on AI in this moment with our friends over at BlackRock. We've also got Goldman Sachs coming on the show to talk about some new data they have on how companies are using AI. And we're going to close things out with a special segment, the launch of the Information's 50 most promising startups known as TI50. Subscribers can get the full list on our website, but all week we're going to be giving you a preview with conversations with some of those founders. It's going to be a busy show, so let's get right on into things. Shopify reported earnings this morning. The company reported 32% revenue growth, though the more interesting story is, of course, the growth rates of the different business lines. Here to break it all down is our e-commerce reporter, Gehan. Anne, welcome to the show. It's great to have you this morning.
Hi, Akash. Great to see you.
So let's talk Shopify. What stood out for you from the earnings this morning?
Yeah, so I think one of the most notable things is their revenue growth kind of keeps chugging right along. That roughly 30% growth rate has been what they've been posting for the past several quarters. So investors really like to see that, and they haven't really seen any slowdown or any dent from increased tariffs. They also say they haven't really seen a meaningful slowdown in consumer spending, which is something that a lot of investors are tracking really closely right now. So I think that top line number, was pretty well received, and I think kind of in line with what people were expecting. And Shopify has been really pushing to kind of expand in, what hasn't historically been their kind of core categories. So they've been growing a lot with merchants that are based in Europe. They've been growing a lot with merchants that do more of their sales in brick and mortar stores versus online. So they're really kind of continuing to sell this story that they're for more than just online sales, and they can really work with any kind of retailer, which, is what investors want to see. I think the one kind of interesting thing to call out from the earnings this morning were that their costs rose a little bit this quarter. And they said that was mostly due to increased marketing expenses as well as some R&D costs, but also increased spending on AI, which is another story that Shopify's been looking to really lean into lately.
How are they leaning into AI broadly from what you've seen?
So it's kind of twofold. It's both internally, within the company to speed up their operations. They talk a lot about being very AI native, using AI for product development, product feedback, understanding what merchants want from Shopify, but then also, incorporating it into their products as well. So a couple of weeks ago, they announced a partnership with OpenAI to make it easier for all of the merchants that are already using Shopify's software to sell products through OpenAI's new e-commerce features. So that's something that a lot of people are really excited about. But I think that approach is pretty in line with how Shopify has historically approached some of these newer sales channels or places to sell. If you think back to the launch of something like TikTok Shop, Shopify was very early to partner with them. So I think it's just kind of a continued, another example of Shopify really making a big effort to help their merchants kind of sell anywhere they possibly can. And obviously being early to AI is something that investors are really excited about.
Great. Well, Anne, I want to thank you for coming on. We should say that shares were down this morning, and I think part of that might have to do with the guidance as well that the company gave, that, as you said, growth is north of 30% right now. They're thinking it's going to come down into the mid to high 20s, and so that will be something to watch in the quarter. But I want to thank you for coming on. That is Anne Gehan, our e-commerce reporter here at The Information. Uber shares were falling this morning, as were Palantir shares. Uber reported this morning, Palantir reported last night. Both companies reported pretty strong results. Palantir, of course, is on a bit of a rocket ship right now. I want to bring on our financial analysis columnist, Anita Ramaswamy, to help us break it all down. Anita, good morning to you. It's great to see you.
Good morning, Akash. Good to be here.
So let's talk Uber and let's talk Palantir. I want to start with Uber because they reported this morning. What stood out to you from the results?
So the biggest thing was the top line news, which is that Uber actually grew its trips by 22% year over year, which is the fastest growth rate that we've seen from this company in the last couple of years. And I think that's really significant because a big part of their success recently has been the rapid growth in their delivery business, which is the Uber Eats and grocery delivery that they're growing out. And they're also at a pivotal time in their ride hailing business as they invest more in autonomous vehicles. So there was a lot of chatter about that on the call from Dara as well.
Right, and I should say, I was listening to the call this morning. The interesting thing was revenue overall accelerated, but both of those business lines, mobility and delivery, accelerated, and delivery was on a bit of a rocket ship. Can you talk a little bit about what you make of that, and is delivery the future here? I mean, I was listening to the call. There was a lot of talk about autonomous vehicles. There was a lot of talk about Europe. Just talk to me broadly about where you see the business going.
Yeah. So, I mean, taking a step back in both businesses, Uber has grown a lot faster in the US than it's been able to grow internationally. The growth rate in its international business actually stayed pretty much stagnant this quarter. So that was one potential reason why we saw the stock fall a little bit. But when it comes to the delivery business and the mobility business, delivery is a lot smaller, but it's growing a lot faster. It's a newer line of business for them. And I thought the most impressive, number or metric in this earnings report was actually that adjusted EBITDA grew around 30% over that actually in the delivery business specifically. And that's notable, Akash, because right now Uber Eats is making a big push into grocery delivery. And grocery delivery is tough. It's an area where companies like Amazon have historically struggled. It's not as profitable as restaurant delivery typically. And so it's possible that, we've seen this acceleration in Uber Eats now, but that may not be as sustainable in the long term as, the mix of business shifts more and more towards the grocery side. I mean, Uber CEO Dara Khosrowshahi said on the earnings call that grocery delivery is actually growing a lot faster than traditional delivery on the Uber Eats side of the house.
And we obviously know that Uber has just come into profitability as of the last couple quarters, last year. I can't remember when it was, but I remember it was a big deal when they finally turned a profit, and everyone was sort of saying, "Oh my gosh, what a story it's been!" And the talk on the call this morning was, we were making these investments into autonomous vehicles, into grocery, as you say. We are staying committed to profitability, and so as you said, that adjusted EBITDA number is certainly something to pay attention to. Let's pivot quickly to talk about Palantir. This is a very different story. What stood out to you there? Gosh, it's hard to pick one number because the numbers are all so big when it comes to Palantir.
Yeah, it is tough, but I think the biggest, most eye-popping number, Akash, that I was really thinking about when it comes to Palantir is the growth in their US commercial business. They grew revenue in that business by 121%. And last quarter,
more than doubled. More than doubled.
Yeah. It's been growing really rapidly in the last couple of quarters, and Palantir is traditionally known, I think, to a lot of folks as a business that focuses on government revenue. That is a big chunk of their business, but their commercial platform, the artificial intelligence platform, AIP, which they've been selling to a lot of different enterprises to help these companies get their data houses in order to run AI apps, has been wildly successful and has started to actually overshadow growth in the US government business.
So this is kind of interesting, though. The commercial business is booming. It's more than doubled. Revenue growth was still just as strong, I think, as last quarter. And yet, shares are down this morning. People are saying maybe it's just kind of a cool off of a stock that is trading at around 100 times next 12 months revenue. What do you think the stock being down today says?
I think it just goes to show exactly what you said, that expectations are sky high for this company. When investors are making projections, if you take the discounted cash flow method and you look at, the next 1 or 2 years, you can say, okay, Palantir is going to continue to grow really fast. We've seen a lot of momentum. But beyond that, it's completely uncertain. And most of the value of that share price is coming from the years past year 1 and year 2, which we don't have any visibility into. I mean, we know that their commercial platform is selling well now, but at the end of the day, that's not been their bread and butter. It's a very new and sort of not tried, not tested portion of their revenue. And so even if you assume Palantir is going to grow upwards of 30% for the next, let's say, 5 years, 10 years into perpetuity, that still doesn't come anywhere close to justifying a $200 per share price. I mean, the price at that point would be somewhere maybe closer to $50 per share.
Have you written a true value column yet on Palantir? You did write one, right?
I did write one when
Okay.
the stock price, I believe, was trading a bit closer to that 50 per share
We'll link it in the show notes. I have to refresh myself, but I remember you having written about it. Thank you, Anita, for coming on. It is a busy time for earnings, so we'll get you back to it. We've got a number of other companies reporting, and so I'm sure we will see you later on this week. That is Anita Ramaswamy, our financial analysis columnist here at The Information. Much has been made about OpenAI's financials, but a new exclusive story in The Information this morning reveals the latest picture of Anthropic's financials. The company is projecting it will grow its top line at a staggering pace, unsurprisingly, and in some categories of its business, it's actually doing even better than OpenAI. I want to bring on Sri Muppidi, who wrote that story this morning, to help us break it all down. Sri, it's great to see you. How are you doing?
I'm doing well. Great to be here.
So let's talk about this big scoop that you had this morning. Lay out the numbers for us. Anthropic is also on a bit of a rocket ship.
Exactly. Anthropic is growing really quickly. What we reported earlier today is that Anthropic expects to generate 70 billion in revenue and 17 billion in profits in 2028, and that's in its most optimistic projections. Basically, Anthropic had raised its revenue projections to be higher than before. When they had last made projections, they're shared with investors back before its March raise, which was done in late 2024. And what we see is that, as I said, that Anthropic is growing much faster than expected. It actually expects to be cash flow positive as soon as 2027, when it will generate 3 billion in profits that year. And comparing it to OpenAI, that year, OpenAI expects to have 35 billion in cash burn and won't actually be profitable till 2030.
So let's talk about where the revenue is coming from, because the breakdown is slightly different than compared with OpenAI.
Exactly. Anthropic has two main revenue drivers. The first is its main B2B business, which is selling Anthropic's models to business customers via an application programming interface, also known as an API. And that makes up roughly 80% of Anthropic's business through 2028. So for this year, for example, Anthropic expects to generate 3.8 billion from API and related sales. That's roughly about double what OpenAI expects to generate from API sales. Although, of course, OpenAI generates a vast majority of its revenue from ChatGPT. That's just a comparison point. The second line of Anthropic's business is its prosumer business, which is basically selling consumers or employees who pay with their own credit card access to Anthropic's Claude subscription premium features. So this includes, for example, the popular coding tool, Claude Code, and the subscriptions for access to these premium features range from $17 to $150 per month. And the other piece that we had reported, and that's a big revenue driver for Anthropic as well, is Claude Code is just growing really quickly amongst both developers and even data scientists and other folks that want to generate something really quickly. And they're expected to generate close to 1 billion in annualized revenue as well.
So the thing that stood out to me from your story is what you were mentioning earlier. The revenue is one thing, but profitability is the thing that is very much in vogue right now for AI companies. And like you said, Anthropic is planning to get to generating free cash flow much sooner than OpenAI. Broadly speaking, the margins feel like they're a lot better than OpenAI. Do we have any sense for why how Anthropic is being more efficient than OpenAI? What's at the root of all this?
So actually, Anthropic had negative margins last year. They had roughly negative 94% gross margins last year, comparing that to OpenAI's 43 or so percent for last year. But Anthropic expects to have slightly higher margins for this year as well as into the future as compared to OpenAI. For example, Anthropic expects 50% this year and then roughly 77% in 2028. OpenAI, meanwhile, has 46% this year and 67% in 2028. I think what the slight differences might be is that Anthropic, for example, only includes the cost of running its AI models and products for its paying users, but not its paying users, while OpenAI includes the cost for both. The other piece is that Anthropic just has more focus in terms of serving just, for example, like business customers, which makes up 80% of its revenue, versus OpenAI is very diversified across different types of products. And so there might be variance in terms of the margins as well there.
Right. And I was going to say, all of this is leading up to, of course, the anticipation of whether or not Anthropic is going to fundraise. They obviously have better numbers now to do it. When do we think we can expect that, and what are you hearing?
I'm hearing chatter that investors are excited to pour more money. There were a lot of investors that weren't able to get into the last round, and it was really oversubscribed. And so I believe that if it were to raise, which we've reported this morning, Anthropic could probably expect a valuation between 300 billion to 400 billion. And so comparing that to OpenAI's recent 500 billion in its employee tender, they're really going head to head. And so I'm excited to see the next couple of months play out as well.
Great. Well, Shri, it was a great story, and I anticipate that we're going to have more reporting from you in the days and weeks to come. Thank you for coming on. That is Shri Muppidi, who covers all things OpenAI and Anthropic here at The Information. Okay, it is only Tuesday, and already the two big news stories from the week, OpenAI's $38 billion deal with AWS and our scoop this morning about Anthropic's booming financials, show the sheer scale of this moment in AI. I want to bring on our editor-in-chief, Jessica Lessin, and Tony Kim, BlackRock's head of global tech within the firm's equities practice, for a bit of a broader view on what this news all means. Jessica and Tony, it's great to have you. Good to see you.
Thanks, Akash. Hey, Tony.
Hi, guys. Great to be here.
So I'm excited for this discussion. Jessica, look, it's been a really busy week. What do you make of the flurry of the OpenAI deals that have going on, the deal yesterday, the news this morning? What's your view on it all?
You know, obviously the OpenAI-AWS deal is really notable. It's a teeny amount of money OpenAI spending, 38 billion relative to its compute. But it's an alliance that honestly was not clear we were going to see in AI 2 years ago, maybe 2 months ago. Right? OpenAI was partnered with Microsoft. Obviously, its compute needs have changed that. But seeing them as now a partner with AWS, I think is very interesting and raises a lot of questions for me about the broader relationship between these two companies. We know shopping is a big priority for OpenAI. So I think, what I've learned in a long time of tech reporting is there's always a lot of negotiation behind the deal. So I think it's an intriguing deal for what it might portend in the future for the companies.
And when you say portend for the future, what questions does it raise for you about the future of OpenAI and the deals that it might seek to strike in the future?
Well, I think, and if you zoom out, Akash, we're seeing, I'll call it a multilateralism. That's a very fancy word that's happening in AI and sort of these big tech giants that we haven't seen in a while. OpenAI also has a deal with Google. Clearly, its chief rival in Google Cloud. We know that Google is pushing TPUs, and I think and continue to hear that people are very excited about the progress in TPUs and expecting big things for them. This is Google's chip that competes with NVIDIA. And so all of a sudden, these companies that were kind of in their lanes as rivals are still competing head to head. But the unprecedented compute needs and just the realities of building this next layer of AI, whether it involves agents that span multiple sites, is leading to shifting alliances. And so I think it's exciting as someone who loves business reporting and just kind of believes you can learn a lot by understanding the relationships between these companies in terms of what products are coming. It is kind of an unprecedented moment where people are no longer in their lanes, and they're kind of frenemies to a whole new level.
Tony, I want to come to you because one of the interesting points here Jessica is making about multilateralism is the number of Mag 7 companies, for example, that OpenAI is doing deals with. And we obviously saw that I think 6 of the 7 Mag 7 companies have reported now. NVIDIA is coming up. But what I want to get your sense on is how this is affecting valuations. We already know the story that once OpenAI issues a press release, they've done a deal with a company, we can expect the stocks to come up, and it ends up influencing the market more broadly. But what do you make for this moment for big tech valuations more broadly as you see it?
As it relates to valuations, I think there is there's constantly changing. I think Jessica said a lot of this is this multilateralism, the amount of compute that is necessary. No one entity can fulfill it all. So this is causing frenemies and cooperation, co-opetition, and it's diffusing across all of the Mag 7 plus, in general, the top 10 tech companies. In the beginning, I think when these deals were announced, these multi-year, hundreds of billions of dollar commitments, you're seeing large stock reactions. as people start to digest and decipher what the implications of these commitments are. And then, as we continue going through this earnings season, certain reactions, certain announcements don't have the same kind of reaction. In some cases they do, some cases they don't. And what is now being digested is, okay, well, these are some mega commitments. What is then the implications of those commitments in terms of balance sheet, cash flow, debt, et cetera? And so you do see different reactions. And I think it's now we're going to this next level and we have to look at the balance sheets. We have to look at the free cash flow to fund these commitments. And in some cases, those companies that have higher firepower, if you will, capacity to fund this might get a better reaction than those that are a little more strained in terms of ability to fund this. So, that is kind of how I see the evolution of the reaction for earnings season. But in the beginning, a few months ago, you would say this is unbelievable, unprecedented number of multi-year commitments. But now, there is a re-examination of that.
Jessica, Tony's making a good point here about how these companies fund all this investment. We saw the CapEx numbers last week ticking up, and I wondered if you could help us put the latest CapEx boom into context. We've seen upticks in CapEx over the past couple of years. What do you think of this moment for CapEx?
I don't think there is a context, although Tony would be much, great authority on this, but we're certainly in really uncharted territory. I mean, obviously the market's reaction to Meta's news last week was notable because it wasn't just the continuation of great spending more, we're more optimistic, right? So there's some shifts there, but the big picture is that investors are kind of buying the story. I think Tony, bringing up free cash flow as the next level. I'm also curious, and would love Tony's opinion on this. I'm curious about the public market's appetite for these fast-growing but money-losing AI companies. I'm not talking about, yes, it would be awesome or so interesting, awesome in a journalist business news sense, to see an OpenAI Anthropic IPO. I don't think they're around the corner per se because they still have a lot of options. But as we look into next year, I do think, and our team continues to hear, more people may be testing the public markets to that point, Akash, of where's this money coming from? But that's still a very open question for me, where investors are going to net out on that.
Tony, pick up on what Jessica's saying here.
Sure, absolutely. Let me give some numbers, maybe to frame this. And Jessica's right. We might not have seen the quantum of dollars that we've never seen, the sheer aggregate number of spend. And we're talking trillions now. But it's a percentage of global GDP. We've had higher spending. In the beginning of electricity or the Industrial Revolution. But in terms of the dollar spend right now, so if you take the 10 biggest tech companies, including the big foundation model companies, and they have roughly $1 trillion of EBITDA. Okay. They also have roughly net debt of zero. So they're not levered. The balance sheet and the cash are roughly equivalent. And there's a $1 trillion of EBITDA. And there's a couple $100 billion of free cash flow after roughly about a $600 billion or more of CapEx next year. So as we said, there's $1 trillion of what I call EBITDA and no debt, no effective net debt. When you start looking at other industries and other kind of the amount of debt that can be sustained, could you lever these things up 1, 2, 3 times net debt to EBITDA? So I don't think generally tech companies have historically not added leverage, but I think there is no doubt that with the amount of the trillions of dollars of CapEx that are potentially coming, there will be leverage that will be necessary. So if you went to 1 times EBITDA, net debt to EBITDA, you'd be at $1 trillion of additional capacity, which most of that will come through leverage, in my opinion. And then there'll be, if you did the 2 times EBITDA, it'd be $2 trillion. So, and that's the kind of the what is coming in terms of the help fund. So there is capacity to fund this from the 10 biggest tech companies. And then there is what I call a cascade downstream, right? You're going to have the biggest spenders with the best credit ratings to drive the spending. And then, from what I see, I still think there's a room to run. And then there will be then you're seeing what you're seeing, as I think Jessica mentioned, you're seeing a lot of these other the diffusion of other data center providers and power, real estate, and all these things that will then serve these big companies, because you're doing some of it, you're building yourself, and sometimes you're leasing to others. And so there's going to be a whole myriad of financing options to finance this.
Right. Well, I think it's certainly an interesting thing to see how it plays out, and certainly to see how the market reacts to that debt, as you say, Tony, if it's coming. I want to thank you both for coming on. That is Jessica Lessin, our editor-in-chief, and Tony Kim from BlackRock here on TITV. Okay. We've tried on this show to get a sense for the extent to which enterprises are using AI, and typically the data points we get are anecdotal from executives, but a new report out from Goldman Sachs puts some numbers to that problem and shows that while many corporations might be using AI, they might not be using it for the tasks that we think they are. Joining me now to discuss the firm's findings are Joseph Briggs, a senior global economist and co-lead of the Global Economics Research Team at Goldman Sachs. Joseph, it's great to see you. Welcome to TITV.
Great to be joining you today.
So let's talk about this report that you put out. What is the headline number for you? I see 37% of clients using AI in regular production. Help us break down what's behind that. Why isn't it higher?
Yeah, so we focus on the concept of use of AI for regular production because we think that it's a measure that is more closely aligned with economy-wide productivity gains. I mean, there's a lot of anecdotal use of AI occurring, across the U.S. corporate sphere today. But it's really the close integration into the regular production of goods and services that we think is going to be necessary to drive the significant uplifts to labor productivity and GDP that ultimately we think are possible. The 37% number that we found in our survey, which we think is broadly representative of use of regular production across corporate America, is much larger than the 10% threshold that's reported in the Census Bureau's Business Trend and Outlook survey. It's also much higher than the 14% number that the Census Bureau finds for companies with more than 250 employees. And so our takeaway was that there's a lot of use of AI occurring in corporate America above and beyond what other data sources were telling us.
Talk to me a little bit about how it differs across industries. And then I do want to get into the headcount reductions and the mix between whether people are using it to reduce costs or improve productivity. But talk to us about adoption across industries, and then we'll get there.
Yeah, it's definitely the case that tech is leading the way in adoption. 63% of technology, media, and telecom bankers in our survey reported that their clients were already using AI for regular production today. That number is expected to rise to 90% over the next 3 years. Economy-wide, our survey suggested that overall adoption is expected to increase to 74% over the next 3 years. And so it's definitely, the case that we are seeing, tech where we do have proven use cases already driving adoption. I'd also emphasize that this corresponds to what we see in the broader macroeconomic data. If we look at the tech sector's share of employment, it's fallen below its long-run trend. We're seeing net hiring in the tech sector underperform by 5 to 10%. And so, the hiring headwinds, the adoption, the productivity gains are definitely playing out in a more accelerated fashion in tech.
What about headcount reduction? How much and what proportion of companies are using it to reduce headcount? I was surprised by what you found. It actually wasn't as many companies as I would have expected.
Yeah, so there's 2 ways that companies can deploy AI, or 2 uses. One is to increase productivity and revenue. The other is to reduce costs and reduce headcount. What was interesting is if we look at the skew across these 2 different use cases, 47% of companies in our survey, at least according to our bankers, are mostly using AI to drive efficiency gains and increase revenue today. Only 20% reported that they were mostly seeing their clients use AI to cut costs. Furthermore, only 11% of our bankers reported that their clients were actually seeing headcount reductions. Again, this is an economy-wide number. If we look at the tech sector, the share of bankers who reported headcount reductions among their clients is above 30%. But the overall message was very much one that we're not seeing significant impacts on headcount as of today. Now, that could change over the next few years, and I think there's signs that it will, but it is a little bit too early to see significant employment effects.
And so I want to zone in on those employment effects. The numbers are what they are, but what is your best guess as to why? Is this just the technology not being good enough? People not seeing the ROI that they thought they would? Help us understand the why here.
Yeah, we actually asked exactly that question in our survey. And our bankers reported their clients were still viewing AI as a bit too early of a technology. And so I think a little bit of hesitancy to dive in full force until the technology matures and the landscape matures a bit. The other thing that really stood out is that a lot of companies were reporting that they didn't have the in-house expertise to develop the necessary AI applications. I actually think this is a bullish story for the overall AI adoption outlook, because if it is the case that it's just too early and the applications aren't quite there yet, then these things will change over time. We are seeing a lot of activity in the application layer. A lot of enterprise solutions are being solved with AI today. As these dynamics mature, we should see adoption occur, and we should see more significant impacts.
And talk to me about, given your macro view on all this, where do you sit on the labor question in AI? If people are looking to reduce headcount or maybe replace workers with AI, like you said, it's not happening right now, but I think a lot of companies are saying, well, that is one clear way to get ROI. What is your sense for what all these people will do if they're not doing the jobs that conceivably can be automated?
Yeah, so there will be a little bit of both. There will be some amount of labor displacement, jobs that are displaced because of AI. There's also going to be a lot of labor augmentation where workers become more efficient because they don't have to do some of the more tedious tasks that they currently have to do and aren't necessarily the main function of their jobs. We wrote a report in August where we looked into the labor displacement question. And if we look at historical evidence, what we came up with was that for our 15% increase in overall labor productivity, which is what we're expecting on an economy-wide basis following full adoption of AI, this should correspond to roughly a 5, 6, 7% of labor displacement. If this happens over a 10-year period, the way that we're expecting, it's probably not going to be that disruptive to the labor market. You're looking at a half-point boost to the unemployment rate in any given year. The big risk is that if we do see adoption occur in a much more front-loaded manner, then the rise in the unemployment rate would be larger and the impacts on labor markets would be more significant. For the most part, we still remain fairly optimistic based on the evidence that we're seeing, and especially on an economy-wide basis, a relatively slow adoption, that the labor market transition will be manageable.
Great. Well, Joseph, I want to thank you for coming on. It's great to have you here on the show.
Great to join you.
Okay. Today, we are launching our 2025 edition of The Information's 50 Most Promising Startups, also known as TI50. And if you're a longtime subscriber, you'll know that every year we put together this list, which consists of the 50 companies that our sources are most bullish on across all sectors, including AI, crypto, energy, consumer, e-commerce, and more. Now, these aren't necessarily the companies with the highest valuations. In fact, one of the precursors to being on this list is that companies should be valued at less than $1 billion and also need to be generating less than $100 million in annual revenue. But for context, some companies on this list in years past have gone on to become tremendous companies, names that you might recognize. In 2021, we picked Hugging Face before the AI boom. The company was reportedly then valued at $4.5 billion 2 years ago. In 2022, we picked Tabular, a company that was then acquired by Databricks later for a reported $2 billion. And in 2023, we picked Perplexity, which we reported weeks ago was finalizing commitments for a funding round, valuing it at $20 billion. To put it bluntly, this list has an extraordinary track record, and so every day this week, we are going to be featuring one company from our 2025 edition of the list across several of our categories. Today, the company that we're bringing on the show is Rillet. The company is backed by big names like Andreessen Horowitz and Sequoia and is trying to build the AI-native enterprise resource planning tool of the future. I want to bring on CEO Nicholas Kopp to tell us more about what he's building and what ERPs really are. Nick, welcome to the show. It's great to have you. So let's talk about Rillet. Congratulations, you're on the list. You made the top 50. Tell us about what you do and how you're looking to overhaul the ERP system broadly.
Yeah, so we're building an AI-native ERP, which essentially powers core financial operations for the fastest growing companies out there, including a lot of pre-IPO companies on Rillet. An ERP for the layman maybe is basically a system that strings together all financial accounting information into one platform. It helps accountants, finance professionals account for what's happened in the past, including expenses, revenue, all these types of things, as well as helps build the foundation for forecasting and planning, which is particularly relevant at this time of year, given it's 2026 soon.
Right. So let's talk about the business performance right now. We've reported that you guys are doing $10 million in annualized revenue. Where is that coming from? Is that big companies? Is that startups?
Yeah. So we are serving today the mid-market of startups, lower enterprise segment. So that is companies like Mercor, who was recently in the news with their recent decacorn fundraise, fastest growing company to get to $500 million of ARR out there. On track to hit $1 billion here shortly. And that's sort of a great example of a company on Rillet. We were also famously powering Windsurf throughout all their acquisition situations. And so that's sort of the type of company we power. A lot of software businesses, professional services, fintech that is running on Rillet today. Instead of the legacy systems are called sort of NetSuite, Workday, Sage Intacct that you may have heard of.
And what is the value prop against using some of these bigger ERP giants that we've heard of?
So it's a few things. It depends also on the team that is using it. There is a functionality that current systems don't have. So we use AI to automate a lot of the tedious manual tasks that accountants do at month end to reconcile their financial statements, to book transactions. And that just reduces massively the time spent for our teams in Rillet to close their books and produce these financials. So that is sort of a hard benefit there. It increases the quality of the reporting as well. So the granular financial information that you get in our application, you can't get out of a lot of other systems out there. And then lastly, and not least actually, is implementations are much faster and quicker. With Rillet, you will maybe be familiar with some 6 to 12 months implementation horror stories from like the big guys, legacy guys out there. So we make that process a lot easier for you to
a lot easier, meaning how long does it take then to implement it with your company?
Yeah, great question. 4 to 8 weeks is the average.
4 to 8 weeks. So I can get an end-to-end ERP accounting software, all my finance systems, 4 to 8 weeks. That's all the transformation will take.
Yeah, it's unbelievable.
Okay.
Yes, it's awesome.
And talk to me about why you're so passionate about why is this problem the thing that you have dedicated your life to?
Yeah. Nobody jumps out of bed and wants to build an ERP or accounting software.
Apparently you do.
Yeah. So I think it's two things that really drive us. So there is a huge problem that can be solved here. I think it's hard to believe for people not operating in the office of the CFO how backward and manual a lot of these processes and systems still are. They're literally 20 to 30 years old. So I'm not sure when you, Akash, have last used a software that's that old. And it really drags people down, and you can have a meaningful impact on so many people's lives and companies and their decision making. So that's one. And then two, just on a more personal note, we're all like nerds about what we're doing. So a bunch of accounting and finance geeks building accounting software with the best engineers. And so on a personal level, it's been extremely fulfilling. Building this product, we have a team of CPAs, controllers, auditors that helps build that product. And everybody has their own little story as to how maybe a system implementation or a system usage has ruined the personal birthday party of a kid, or has like personally put them through weekends and weekends of work. So we're all very passionate about solving this problem at its core.
Right. Well, Nick, I want to thank you for coming on. Congrats on making the list, and we'll hope to see you soon.
Thank you.
Well, that does it for today's show. A reminder, we are on this stream Monday through Friday at 10 a.m. Pacific, 1 p.m. Eastern. I want to thank Amazon Web Services, who is our presenting sponsor for this production. And I want to thank you for tuning in. We really do appreciate your viewership. I am already excited for our next show tomorrow. Have a great rest of your Tuesday. Bye-bye for now.